I want to focus on the other part of the Federal Reserve System, and that is the regional banks. Unlike the Board of Governors here in Washington, which is a public body with governors nominated by the President and confirmed by the Senate, the 12 reserve banks are private corporations overseen by private citizens, including a lot of bankers. Even so, these private reserve banks are permitted to play a crucially important role in public policy, including voting on interest rates and supervising banks. In the case of Silicon Valley Bank, the San Francisco Fed was the regulator on the ground responsible for ensuring that SVB was managing its risk. But the San Francisco Fed clearly failed to do so. By the time SVB collapsed, it had 31 unresolved supervisory issues, triple the number of warnings that similar banks had, which was already too big. It is great that the San Francisco Fed sent those warnings, but what's the point of sending warnings if there's no follow-up? Do you think no one is paying attention? Why didn't the San Francisco Fed force SVB to address the problems that the San Francisco Fed had already identified? Not they needed to figure out some other stuff, the stuff they clearly knew. So Dr. Connie Brown, I know that you have written a lot about the reserve banks, so let me just ask you for a little background here. Let's get this on the record. Who are these private citizens who oversee the 12 reserve banks?
Well, they hold an extremely important public trust, but they're not public officials. There are 9 of them total for each reserve bank, but there are reserve bank branches that consist of other boards that serve in a similar kind of role. For the reserve banks, these 9 are divided into 3 classes, classes A, B, and C. Class A are the bankers themselves. They are folks like Greg Becker, who was the president of SVB, who one minute would be sitting on the boardroom at SVB, and then I'd look at his watch and run over to the San Francisco Fed, so I've got another board meeting to go to. The next 3 are non-bankers, or at least not currently bankers, but they're also appointed by the bankers, supervised by the Fed. And Class C are to represent the public. They're appointed by the Board of Governors. Historically, all 9 of them were either recent bankers, current bankers, or distant bankers. Class C in the last 15 years or so has been better diversified.
So let me just get this straight. 2/3 of the people that oversee each of the reserve banks and handpick the leadership are elected by the very same banks that are regulated by the Reserve Bank. And 3 of those people actually work at the bank, right? That's how this works.
That's right. Dodd-Frank did.
People wouldn't believe this. You realize?
No. People think it's you're sending up quackers conspiracy theories when you tell this. It's written in the Federal Reserve Act. And one change that was made by Congress in 2010 is that the Class A directors, these are the bankers who are currently working as bankers, can no longer vote on the appointment of the Reserve Bank president. But we don't know what they can say about it. And I've talked to some people who say, oh, no, it's a very strict wall of separation. And others say, oh, they're constantly participating in these same kinds of discussions. As with nearly everything about Reserve Bank governance, the public has no idea.
Right. Okay, so this chummy little group is making a lot of policy here, and nobody else gets to see it. And you mentioned that one of the directors at the San Francisco Fed was Greg Becker, who at that very moment was also CEO of SVB. In fact, Mr. Becker, I just want to draw the line, was a director overseeing the regulator that was supposed to oversee Mr. Becker's bank. And this is exactly at the time that SVB received 54 supervisory warnings from the San Francisco Fed bank examiners, and the bank examiners, surprise, surprise, made no follow-up to force SVB to change any of its practices. So, Ms. Rodriguez-Valladares, does the fact that the CEO of SVB was on the board overseeing the San Francisco Fed, SVB's regulator, raise questions for you about whether or not his presence on the board could have affected the strength of the San Francisco Fed's supervision?
Absolutely. He never should have been there, and it is something that is of great concern. He himself yesterday, when he testified, mentioned that he frequently met with the president of the San Francisco Fed at least once a month, sometimes more frequently. And it's very, very difficult for examiners or anybody else at any of the district feds to say anything that is going to be critical of one of the board members. That kind of mechanism doesn't exist, and it's unfortunate that there still hasn't been a complete independent investigation of the SVB failure, because there's a lot of documents that were missing. Normally, what happens, you examine a bank and you write about your findings and you submit your notes, you submit all of your documentation to what's called an EIC, the examiner in charge, and then he or she will review it, and then there's various other layers of middle management at the district feds that will look at those reports. So we, the public, have not seen, wait a minute, those risks were identified at SVB year after year, but what kind of middle management or anybody else got involved in the writing of the report? Also, in a little footnote in the CAMEL's examination reports, it says that the person who wrote the report was chosen by the Board of Governors. And so what then is exactly the relationship of the Board of Governors and the San Francisco Fed in this specific examination? So those details are very important.
So it sounds like to me that this is clearly a case of the fox guarding the hen house, and all the way through the system here. I want to note, this is not the first time. It's not like we pull back the curtain and are shocked to discover this happening in 2023. Back in 2008, JP Morgan's CEO, Jamie Dimon, was sitting on the New York Fed board at exactly the same time that his bank was borrowing emergency funds from the Fed. And who was the chairman of the New York Fed board at the time? It was the former head of Goldman Sachs, who was serving on the Goldman Sachs board at the same time, even as Goldman Sachs was borrowing billions of dollars from the Fed. And of course, all this happened at the same time that the Fed banks were recommending to Congress to do a huge bailout for the giant banks. So this has obviously been going on for a long time. Now, after 2008, Congress took steps to address these gross conflicts of interest at the Reserve Bank boards, but clearly we've still got a long way to go on this, and this is why Senator Rick Scott and I introduced a bipartisan bill today that would prohibit big bankers from serving as Reserve Bank directors. It would also subject directors to ethics and financial conflict of interest rules. It would foreclose any opportunity for directors to interfere with the supervisory process. You know, Dr. Kupiec, I'm afraid you're not going to get in on this, so if I can, I'll just turn to you and ask you, do you think if some of the legislation, like the kind that Senator Scott and I have proposed, I don't know if you've had a chance to see it in any detail, but would it help some with these conflicts of interest?
I have not read the legislation, but I would
I'm
point.
sorry, I didn't mean to cold call you on that.
No. Well, I looked a little bit at the IG, which I think is a good idea, but I would point out that the other two banks that failed are not part of the Federal Reserve System, and Signature Bank had Barney Frank on its board of directors and Alphonse D'Amato, a former senator, the head of the banking committee, on its board of directors too. So there's a lot of blame to go around. So and that's not to say Mr. Becker it gets off the hook, but there are prominent connected people on boards of directors.
Conflicts, I think is what you're saying.
On lots of
Dr.
boards of
Kupiec.
directors.
Is that a fair statement? We got a lot of conflicts here. Well, let me ask you, Dr. Connie Brown, would these reforms that Senator Scott and I have proposed help address conflicts of interest in the reserve banks and maybe strengthen a little public confidence in the supervisory powers of these banks?
My only reaction is to take the maybe out of that sentence. I think that it is almost circular to say that this would help with the conflicts. And I just want you to be, I just want to be clear, this is a moderate position. I would go much further. I would fire bankers from these boards entirely. And I recognize that there are politics here and there are interests involved. And so I think that the proposal from you and Senator Scott, which I have reviewed, does not go as far as I would like, but it does go, but it does help to manage these questions and makes it so that when you tell someone who's interested in the well-being of our country and its financial system about these strange curiosities, the Federal Reserve banks, it would help so much to be able to tell them that those with the largest banks do not participate in that governance.
Right. And would you like to add something to this, Ms. Rodriguez-Vallardes?
Yes, I've actually looked at both pieces of bipartisan legislation, and I am impressed with them. I agree with Dr. Conti Brown that I think it would be a very good idea not to have any bankers at the boards. The skill sets that they bring can be found elsewhere, and frankly, there's a danger of having too many bankers on the boards. You really need cognitive diversity. They would be much better served if they had somebody, let's say, from an independent broker-dealer that has nothing to do with the Fed, for example. They could have people there from the American Red Cross or such organizations that are experts at dealing with chaos and unexpected problems. You frankly would need a scientist. So there's a lot of different skill sets. There's a lot of value in cognitive diversity that's very, very important. And like these gentlemen, I concur with them that an inspector general who would be appointed by the president and confirmed by the Senate would be a much, much better situation. It is very, very difficult to go tell the people with whom you're working and you see on a day-to-day basis that they're doing a bad job. And the minute that you hear the word bonus anywhere, it immediately means that your own salary depends on their performance. And so you can't call out wrongdoing in an independent way, and you're not accountable to legislators.
I appreciate that.